Ever been paralyzed by an investing decision? You have a chunk of cash, maybe a bonus or a tax refund, and you stare at the buy button, wondering, do I dump it all in now, or drip feed it slowly? This is the classic dilemma of lump sum investing versus auto deposits, or what the pros call dollar cost averaging, and it's a question everyone faces on platforms like Wealthsimple. So, which method is actually better for building wealth? Let's break down both, starting with auto deposits, which is a key feature in Wealthsimple's self-directed investing. Auto deposits, or dollar cost averaging, is about consistency. You set a fixed amount, say $500, to automatically buy a stock or an ETF every 2 weeks, regardless of the market price. Wealthsimple makes this incredibly easy with their recurring investments feature. The massive benefit here is that it removes emotion from investing. You're not trying to guess the bottom of the market. Since you're buying at different price points over time, you lower your average cost per share, which is why it's called averaging. It's perfect if you're paid regularly or if the idea of a market drop right after a big investment gives you a serious headache. It's the disciplined, set it and forget it approach. Now, let's look at the competitor, lump sum investing. This is when you invest all your available capital at once. You put that full $10,000 bonus into your Wealthsimple TFSA today. Historically, this strategy tends to generate higher returns. Why? Because the market tends to go up over the long run, and by getting all your money in right away, you maximize the time your money is in the market, letting compounding work its magic sooner. Studies, including research from Vanguard, suggest lump sum investing outperforms dollar cost averaging about 2/3 of the time. The trade-off is risk. If you invest a lump sum right before a short-term market downturn, you immediately see a paper loss on your entire investment, and that can trigger emotional panic. So, how do you choose on Wealthsimple? It really comes down to two things, your cash flow and your psychology. If you earn a regular paycheck, auto deposits are your reality. You don't have a huge lump sum, you have consistent income, and auto deposits are the best way to ensure you're always paying yourself first. However, if you have a significant windfall, an inheritance, a big bonus, proceeds from selling a property, and you're comfortable with the idea that the market might dip after you invest, then statistically, the lump sum approach gives you the best odds for maximizing returns over decades. But here's the key takeaway, the worst decision is doing nothing. Keeping your money sitting in cash out of fear means it's not growing and it's losing purchasing power to inflation. Both strategies, auto deposits or lump sum, are vastly superior to staying on the sidelines. Decide which method helps you stick to your plan, the steady, low-stress automation of auto deposits or the higher potential returns of lump sum for a large windfall. Then, use Wealthsimple's tools to automate your chosen path. With that said, thanks for watching and until next time.